Where are we headed, and what are some cues to watch out for, in your opinion, for investors?
Yeah. Okay. So I think there are two, I would say, key variables which will be determining the outcome both for the fixed income markets and for the equity market. One is the old one, pretty old one. We have forgotten it for the last 7, 8 years, at least in the global markets, and that is inflation. What we are seeing is, last 2 years we had this mother of all stimuluses from both the central bankers and the fiscal authorities, and that came in the wake of this COVID pandemic, uh, and all these bottlenecks which were there in the COVID pandemic, and that had resulted in big flare up in inflation across the world, in and also in markets in economies where people were never used to inflation. I mean, policymakers had forgotten that there is something called inflation. So in US, the numbers are coming at 4 decade high. We are getting upside surprises also in United Kingdom, also in Europe. We are getting the high inflation. Commodity prices are ballooning across the, I mean, booming, across the board. Crude prices yesterday were 90 plus. So that inflation is a big scare, and that is remains the key variable to look into. That will determine the course of both the equity and the bond market. And second one, I would say, is COVID. Uh, we've had waves after waves, and while the impact of every subsequent wave has been declining, but it impacts economies in two ways. One is in terms of the actual demand destruction when people lose jobs and can't go out of their home, and second is in terms of dislocation of the supply chain. So over the last 2 decades, global supply chains have been extraordinarily diverse, uh, spread out against across the world. Something, getting made in Korea, some in Taiwan, some in China, some in Vietnam, and then that travels across the value chain through ships and all. And COVID was the perfect nightmare for such a scenario. And so while the direct demand side impact of COVID has come down, as we can see around that, people are getting more comfortable in dealing with COVID. The virulence of this latest virus was much lesser. A lot of us are, globally, have got vaccinated, either through the actual infection or through the actual vaccination. So while the demand side impact of COVID is limited, the supply side disruption that it can cause is still there. So that is another variable which we should track. Our base case assumption would be that, given that every subsequent wave is turning out to be less virulent, and Omicron was especially non-virulent. So while the impact of COVID may keep on declining, inflation remains the key worry for the markets. Uh, you know, Last 2 years, a lot of people were quite astonished that how come in such a massive crisis, global health crisis, how did markets flare up so much? And the simple answer, which most of us now know, has been that of this extraordinary stimulus which had gone into the market, both fiscal and monetary. Now, with inflation coming back with the vengeance, central bankers are turning, dialing back their extraordinary accommodation. So while most of the last 2 years, every subsequent statement which used to come from Fed and the Fed speakers used to be like, competing with each other, ki how dovish they can be. Now
Hmm.
it's almost the 180-degree turn that we are seeing. Every subsequent data point, every subsequent communication from Fed, that is coming, you know, incrementally more hawkish. And that's not only in Fed, across the board, across the world. You look into global central bankers, everyone is dialing back their extraordinary stimulus. So that is going to be one very key determinant, that how fast they dial back the stimulus and what impact it has on the markets. Because in equity markets, one key reason why probably this market has gone up so much. One is the quote unquote the liquidity which the central bankers supplying the market by doing quantitative easing. The second is when they reduce the discount rate, everything gets discounted. Every future profit gets discounted by a lower rate, and that reduces the expectation of returns in the stock market. So this remains a very key variable, and I think that uh, for the last post global financial crisis, the markets have got used to this Fed put, as they call it, that bad data is actually good data because Fed will come in. Now that Fed put is very much in question, or at the very least, you can say that the strike price of the put is much lower. So
Hmm.
in 5% correction, 10% correction, don't be sure that Fed will come to save the market. They have been under a lot of criticism. Now, inflation has become a political issue in US because uh, getting 5% inflation, then 6%, then 7% inflation persisting for an economy which is used to 2% or less than 2% inflation. So this political pressure has built up a lot in Fed that they are looking after the rich people, the markets, and not, the Wall Street and not the Main Street. So all this combined.
That could happen here, right, Bhupesh? That could happen here as well, because that could happen here as well, right? Because the fiscal firepower is almost close to exhaustion, considering the period of extensive easy money policies that we have had. And as India itself faces an election year, the question is, with limited fiscal firepower and inflation still as a major headwind, what does the government do? So that's a question which is still left to be addressed. Are you optimistic about the prospect?
So generally, so equity markets returns are determined by two factors. One is what is the growth, and second is what is all the sub factors, the policy, the interest rate, the discount rates. I think from a growth point of view, we are in the cusp of a multi-year, hopefully in a cusp of a multi-year bullish run in terms of economic growth. So last 5, 6, 7 years, they have seen a lot of growth costs in terms of structural reforms, bringing down inflation, GST, IBC, bankruptcy code. Then we had this big COVID shock, demonetization. Hopefully, I think we won't be getting. We can only hope that no other extraneous shock should come to the economy now. If that hope is not belied, then I think, given that balance sheets are very clean, policy rates are still very low, real rates are significantly below zero, and government is focused on building capacities. Plus, after 7-8 years, if you haven't invested, the cyclical sector also starts turning up. So from a growth point of view, we remain quite bullish that India can grow at a pretty decent rate over the next 5, 6, 7 years, and that should provide a lot of support to the equity markets. The problem is, that equity market is a combination of what is happening in the growth front and what is happening on the policy front. And there, the global backdrop in particular isn't that benign. So I think the best case would be, the best judgment you can make right now is that it should keep trending up, but it won't be as smooth a ride as you had seen in the last 2 years. Because with Fed tightening its monetary policy, Fed is like a central bank to the entire markets, the whole global market. If Fed start tightening the policy, it does create a lot of volatility that you can't avoid. For the fixed income market, I think rates have already gone up quite a lot, and fixed income has to be a part of your overall portfolio, especially it's counter-cyclical typically to the equity markets. And at points, at 4% point, at 4 or 5 year duration point, there's still a lot of juice still there in the fixed income market. So you have to choose your point accordingly, where you are positioned in the fixed income market. There are a lot of places in fixed income market where you can still make decent returns. While generally one would believe that in a rising interest rate scenario, you should stay away from fixed income market, but I won't say that, because fixed income has to be a part of your portfolio, and given the fact that yield curves are very steep, if you're rightly positioned in the fixed income market, you can still get pretty decent returns.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.